What's up, guys? It's Ron from Ronald Rohde Law, and in this video we're going to talk about how to do seller financing on commercial properties in this interest rate environment. If you subscribe to this channel, you know that we talk about all things commercial real estate, helping with acquisitions, dispositions, and triple net leasing. I'm also a huge industrial investor. Check out my book. It's just released on Amazon. It's getting huge reviews all over Twitter, but that's enough about me. Let's talk about seller financing, because this is one of the shifts in the real estate market that is different from 2008 and 2009. The reality is that deals are getting done. You have to offer seller financing because these sellers are not in a rush to sell. They have a lot of built up equity and they're not being forced. Their hand is not being forced to sell. And so you as a buyer have got to come up with a creative solution, which I consider it a de-risking, converting a seller's equity, which is paper gains, into debt, which is still paper gains, but it's a little bit more tangible as debt versus cash. And so everything is a spectrum of risk. If you're in commercial real estate, you have to understand risk, how to quantify it, how to evaluate it, and then ultimately how to pull the trigger. But in this video, we're going to walk through a sample term sheet, and I'm going to give you actual numbers, okay? At our law firm, we do a ton of seller financing, whether it's LOIs, whether it's closed deals, drafting the notes, doing the deeds of trust. We do a lot of seller financing as the way to get deals done. Motivated again by this email I get CRE daily. This one's from a couple of days ago. CRE markets face a downturn. They're using incentives like seller financing to attract buyers. And they show a nice little graph that shows in the first half of 2023, we have 2% of deals with seller financing. This is absolutely true. Let's take a look at what terms you should actually provide. I don't know if they talk about terms in this article. The debt markets are terrible, says head of Newmark. 2% of all deals compared to 0.5% before because you don't have the traditional lenders. Seller financing is a very, very good option. You save a lot of money on the upfront due diligence. You typically don't have to do an appraisal. You don't have origination fees. You probably aren't paying too much in legal costs. You really save a lot of transactional costs. The terms can be negotiated fairly quickly. And maybe most importantly, you have that certainty of the debt financing because the seller is incentivized to get your equity. And you better be putting a pretty big equity check. But if you're doing that, the seller is motivated to close as opposed to a third party lender. In this market, this is, October 2023, I have heard so many horror stories of lenders changing the terms a week before closing and saying, tough, go deal with it. And it's very tough to do business with a third party that has all the leverage in the transaction. So seller financing is very attractive if you can make it work. None of this stuff, I think is that useful. I'll drop this Bloomberg link in the description. Let's go to some actual terms. This is one of my companies, FF Real Estate. We do use this. We actually submitted this. So we have a letter of intent, 5 acres, Haltom City. People know I love this area. It's right outside Fort Worth. It's a working class neighborhood. And this is just a sample letter of intent, purchase price. So $3.4 million and seller financing here. So we're offering here 60% seller holdback note. Which works out to about $2 million. And that means the balance of 1.4 of equity comes in from the purchaser. This is a very important part to start with. I think you need to be starting from a 50% leverage ratio to get the seller interested. They need to be putting a significant amount of equity in their pocket. Either if they have an existing first position lien, they need to be able to pay that off from your proceeds. And you want to put some money into their pocket. To make it attractive, they've got to have some money in your pocket. So think about this. If I don't necessarily want to pay $3.5 million, I would rather pay a lower LTV with a higher equity percentage to save the purchase price, to preserve your basis. And this is where cash is king. You want to start around 50%, but your opening negotiation maybe is a little bit higher, knowing that if they counter, you're willing to come back down to 50%. We just have some other terms here, 6%. I think from my perspective, I want to be looking at what a 30-year or maybe a 5-year T-bill is offering and quote them a rate that's actually better than that. Because by holding this paper against the property, they are taking a little bit more risk. It's a little bit more hassle, but I don't necessarily want to offer them attractive private money rates because I would be willing to go get a third-party lender if they wanted 10%, for example, or 12% interest. I am not a bad buyer. I am trying to find what the lowest interest rate they're willing to accept is. And so I'll just open at 6%. My tip for people watching this video is that the interest rate is probably your least important factor. I really care about LTV and the amortization. Those are probably my two most important factors. But interest rate, go ahead, open with something that has got to be above the 5-year T-bill. Important here, principal and interest. I want amortizing. I want P&I being paid. This is just from my perspective. I've been on these receiving ends and I like my risk of my holding my note to go down every month by paying principal. If you're on an interest only seller financing, my risk never goes down and I don't like that feeling. I as a lender want my risk to be decreasing a little bit. So I think it's important to offer P&I a 5-year term, right? So it's going to be fixed rate. I think you need to open with a long enough term that you can complete your value add and give yourself enough time for a refinance. So whether the rates come down or you can increase the income higher, you've got to give yourself enough time. So I open with 5. Maybe I could take, 3 or 4, but you really need the seller to say, I'm open to seller financing, but could you do a 3-year term? That's the difference of opening with a 5 versus opening with a 2. If you only opened with a 2, you've got nowhere to go if the seller wants something shorter. 12 months doesn't do anything for you unless it's a very, very short bridge debt. 25-year amortization. This is where there's some wiggle room, and dependent on how savvy the seller is, he's going to be able to calculate what his payment is off of all of this information. And the 25-year AM is a little bit long. I think most banks, they'd be offering you a 20-year AM. So this decreases our payments a little bit. But overall, I kind of have the approach that I'm not going to be holding this seller financing all the way to term. I'm going to want to refinance. And so I'm a little bit more flexible. I could come down to a 20-year AM. But key takeaways of the terms of seller financing are the LTV, that's the loan to value ratio, loan to purchase price. And it's got to be something up like this where I'm stroking a $1.4 million equity check. That's just the way it is because I'm saving appraisal costs. I'm saving time delays. I'm saving legal fees, no origination. All of these costs are saved. And so you've got to come with a strong equity at closing and not give a traditional, maybe a 80% LTV, maybe even 75% LTV. That's not attractive for a seller unless he has stated that he wants a seller financing offer. Other than that, this LOI is pretty basic. I don't think I really need to go through. We have earnest money, we have a due diligence period. Everybody should be stretching those, by the way. Sellers are open to that. You don't need a 45-day, 30-day close, a 30 plus a 5. That used to be at the height of the market. Boom, boom. It was a 30-day due diligence and a 5-day closing after that. Now, ask for 90 and settle for 75. Ask for 75 and settle on 60. You should have plenty of time to do all of your due diligence while you've tied up the property. Brokers, go ahead. Try to get your broker paid if you're on the investment sales side. It's fine to ask. Closing costs. Again, I still think closing costs can be split 50-50, but it's a negotiation point in addition to your seller financing. I always sign mine too, and I don't know what happened here, but oh God. That's what it should look like. You got to check this before you send it, but that's what it looks like. I always send my LOI signed so that the seller just needs to sign their end and we're good to go to work towards a PSA. But that wraps up this seller financing actual deal terms. This is for an industrial deal. So smash that like button, subscribe if you have any seller financing questions, and we'll see you next time.